The REIT earnings season is now well underway and it's leading to a lot of interesting buying opportunities. As usual, investors are quick to overreact to short-term news, and this is leading to lots of volatility on the upside when good news come out, and to the downside as REITs face temporary setbacks. But in reality, REITs should be valued based on decades of expected future cash flow, and therefore quarterly results really shouldn't have such a big impact on the valuations of REITs. If you understand this and have a long-term horizon, you can often take advantage of the short-term volatility by buying shares of REITs that have recently sold off and become undervalued. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to talk to you about 2 REITs that I'm buying the dip that I think most investors should own. But before I get into it, 2 quick things. Firstly, I want to thank all of you who have donated to our fundraiser for Ukraine. We are now over 50,000, which is amazing, and we almost have enough money for our coming trip. If you want to learn more about it, I'll put a link in the description of this video. Any help is greatly appreciated. Thank you so much. And then secondly, please let me know in the comment section below what REIT you would like me to cover next. So the first REIT I'm going to discuss here is called First Industrial Realty Trust, ticker symbol FR. We just recently invested in it at High Yield Landlord. We decided to sell our position in Stag Industrial, which is another industrial REIT, and reinvested the proceeds in First Industrial because we think that's even more opportunistic. Since then, share prices have moved a bit, they've risen a little bit, but the thesis still remains intact. Prologis, which is the biggest industrial REIT in the world, just recently released disappointing first quarter results, and this caused all industrial REITs to sell off. But I think that this is a great opportunity because of 3 key reasons. Firstly, the management of Prologis noted on their conference call that their poor results were mostly the result of delays in their leasing due to the uncertainty at the moment. A lot of companies are delaying their leasing decisions, but they still remain very optimistic about the coming years, especially as the supply drops down considerably from the levels of 2024. Secondly, most of these industrial REITs enjoy a very significant mark-to-market in their leases because rent growth has been far faster in the market than the lease escalations over the past decade, and as a result, most of these REITs are able to bump up their rents by 50% or more as their leases expire. On one hand, this provides margin of safety in case fundamentals deteriorate from here, and on the second hand, it also provides essentially a bank of growth that they have already secured. Then thirdly, we need to remember that Prologis is massive in size, and so it's not specialized in anything in particular. It owns properties all over the place, and so I think that some of its close peers that are smaller in size and more specialized are quite a bit better positioned, and yet they have sold off just as much as Prologis. As a result, I think that most industrial REITs are today undervalued, and if I had to pick one, it would be First Industrial REIT today. Its share price has crashed by about 30% since the beginning of 2022, even as it grew its cash flow by 22% since then, and so as a result, its valuation multiple has now been cut in half. Therefore, it's now priced at one of the lowest valuation multiples in the industrial property sector, and that's despite enjoying some of the fastest growth prospects. Currently, its FFO multiple is 17.5 times, which may not seem that low to some of you, especially if you're used to buying REITs like EPRA properties at just 8 times FFO, but there are a few important things that you need to consider here. Firstly, its current rents are deeply below market, and as its leases gradually expire over the coming 3 to 4 years, it's expected to enjoy 40 to 50% rent bumps. Secondly, the REIT earns a vast land bank that today is not earning any cash flow. This is simply land that's sitting on its books, but still very valuable, and historically the REIT has been able to develop new industrial properties at a 7% initial yield, so as it gradually develops this land over the coming decade, it will massively boost its cash flow. And then thirdly, this is a REIT that has very low debt. Its LTV is just around 25%. It has no debt maturities until 2026 from the top of my head, maybe 2027 even. And so this also justifies a higher valuation multiple. And so when you take all of this into account, its FFO multiple is actually very low for the REIT. Historically, it has traded at closer to 25 to 30 times FFO, and this is justified because if you now simply adjust its rents to market levels, its FFO multiple will be in the low 10s. I also estimate that it's priced at a roughly 30% discount to its net asset value, which is exceptionally low for such a high quality REIT with such rapid growth prospects. Its implied cap rate is in the low 6 today, but if you again adjust its rents to market level, it would be in the 8th, which is really unseen for Class A industrial properties today. Just recently, Rexford Industrial REIT, which is another peer of First Industrial, they just recently acquired a portfolio of industrial properties from Blackstone at a 4.7% cap rate, and they thought that they were getting a good deal. Well, First Industrial is way cheaper than that. So far this year, First Industrial has enjoyed 45% rent bumps on its new leases, and I think that as it keeps bumping up its rents very significantly over the coming quarters and years, eventually the market will take notice of this and it will reprice it at a materially higher valuation multiple, because otherwise it will start trading at an exceptionally high implied cap rate, which wouldn't make sense for these assets. Finally, the dividend yield here is pretty low at around 3.3%, but keep in mind that this is because the dividend payout ratio is also very low at just around 50%. And I like that they're retaining a lot of cash flow to reinvest in growth because, again, as I mentioned earlier, they have this land bank, they have great investment opportunities to create value for shareholders, and it's also more tax efficient for shareholders because they retain more of it. REITs don't pay any corporate taxes. It allows us to compound a bit faster, and also the dividend is enjoying some of the fastest growth in the entire REIT sector. It's been hiked by 15% so far this year. I think it's the fastest growth in the entire REIT sector. If you know another REIT that's growing its dividend faster, let me know in the comment section below. And so between the yield, the growth, and the multiple expansion, I think that it's quite realistic that this REIT will deliver roughly 15%, possibly even more annual total returns over the coming many years. And for this reason, I've now started investing in First Industrial. And then the second REIT in which I'm buying the dip is called Crown Castle, ticker symbol CCI. This is one of the leading cell tower REITs. It actually reported pretty strong results, but despite that, its share price has now crashed down and it's back to where it was in late 2023. It seems to me that the market doesn't like the uncertainty that's caused by all the different groups of activist investors that are now fighting over Crown Castle and how it should unlock value for shareholders. Some of them want Crown Castle to sell its fiber assets, to cut the dividend, to focus more on deleveraging and growth. Some of them want Crown Castle to follow the footsteps of American Tower, its close peer, and expand in international markets. There are a lot of different propositions, and all of this is leading to a lot of uncertainty. The market hates that, and as a result, the share price of Crown Castle is decreasing. And I can understand that if you're an income investor, this is negative news because it's quite possible that Crown Castle will cut its dividend, because if it sells a big chunk of its assets, the fiber portfolio, its dividend will simply become unsustainable because the payout ratio will be too high. But I still view this as a net positive because having all these activist investors who are highly sophisticated, I mean, we're talking here about Elliott Investment Management, and the other activist group is led by one of the co-founders, former CEO of Crown Castle. They built also a very significant position in the company and they just wanted to go a different path. But these people are highly sophisticated. They've invested tons of resources into analyzing the company and they've come to the conclusion that it is heavily discounted. So I view this as a positive, and they will keep the management in check to make sure that they are following the right direction to unlock value as fast as possible. And if the right path is to sell these fiber assets, I would expect this to unlock value for long-term shareholders. Obviously, it could lead to short-term volatility, but overall, over the long run, if they do so, it would be a net positive for the company. If I had to make a prediction today, what I would expect to happen is that as the capital market starts to reopen, as interest rates go to lower levels, then Crown Castle will sell its fiber assets. It's probably going to wait until then so that it can maximize the proceeds. It will then use this money to pay off some debt, reinvest in towers, possibly in international markets. So it will refocus on the cell tower business, which is really the bread and butter of Crown Castle. And this is going to lead to an FFO multiple that's higher than that of today and unlocking upside for shareholders. This will likely lead to some bumpiness, some volatility in the near term, but we also shouldn't forget that the main business of Crown Castle is doing well, and I remain confident that its growth will also re-accelerate in the coming years as it moves past the impact of the lease cancellations of Sprint, which was acquired by T-Mobile. Today, the company is still priced at about 12-13 times FFO. I think that could easily get back to 20 times FFO. Even that would represent a pretty steep discount to where it's traded out during most times of the past 5 to 10 years. And so here you have a path to realistically getting about 50% upside while you wait, you're earning a significant dividend yield. Currently, it's over 6%. It probably won't be cut tomorrow, but it is a possibility that eventually it will be cut. But if it is cut, it would be for a good reason. It will be because they're unlocking value by selling some of the assets, and this would lead to a higher valuation multiple, an even higher one, leading possibly to even more upside down the line. I love REIT earning seasons because it always leads to some interesting opportunities, because most investors are very focused on short-term results. They think that quarterly results are very important and share prices will go up 20%, down 20% simply if a company misses or beats its expectations. But as a long-term investor, I recognize that these quarterly results really aren't such a big deal in the grand scheme of things. What really matters is what's the trajectory of the company over the next 10, 20 years. And so it's leading to some great buying opportunities. I think that First Industrial and Crown Castle are good examples of that, but there are many other instances in the REIT sector, especially at the moment. If you want to gain access to everything that I'm buying in real time, all my trade alerts, we post them at High Yield Landlord, which is my REIT newsletter. You can access it for a 2-week free trial. I'll put a link to it in the description of this video. And then finally, if you thought that this content was useful, I would really appreciate it if you click the like button, subscribe to the channel. Thank you so much in advance. See you at my next one. Bye-bye.